Welcome back to the channel. Today, we're diving into the history of the stock market to uncover the 5 biggest crashes of all time. From the Great Depression to the more recent COVID-19 crash, we're going to analyze what caused these market meltdowns and their impact on the economy. Understanding these historical events can provide valuable lessons for investors today. Let's get started. The stock market crash of 1929, which kicked off the Great Depression, remains one of the most significant financial disasters in history. It serves as a stark reminder of the devastating consequences of unchecked speculation and the fragility of the financial system. Imagine this, the Roaring Twenties, a time of economic prosperity and optimism. The economy was booming, and people were confident that the good times would continue indefinitely. People from all walks of life were pouring their savings into the stock market, convinced that the rising stock prices would make them rich. It was a time of speculative frenzy, but beneath the surface, trouble was brewing. The market was overvalued, and many stocks were trading at prices far above their actual worth. On Black Tuesday, October 29, 1929, the bubble burst. The market plunged, wiping out billions of dollars in wealth in a matter of hours. Panic selling gripped investors, triggering a chain reaction that reverberated throughout the financial system. People were desperate to sell their stocks, but there were no buyers. Banks failed, businesses shuttered, and unemployment skyrocketed, reaching a staggering 25%. The financial system was in chaos. The effects were felt globally, plunging the world into the Great Depression. International trade collapsed, and economies around the world suffered. In response, the government implemented various programs like the New Deal to stimulate the economy and provide relief to struggling Americans. These programs aimed to create jobs and restore confidence in the financial system. The stock market wouldn't fully recover until the 1950s, a full 2 decades later. The crash left a lasting impact on financial regulations and the way people viewed the stock market. President Herbert Hoover, who was in office during the crash, initially believed that the economy would recover on its own without government intervention. Influential economist John Maynard Keynes argued for increased government spending to boost economic activity, a theory that would later influence New Deal policies. Key events leading up to the crash included the London Stock Exchange crash in September 1929 and the subsequent panic selling on Wall Street. Major financial institutions like J.P. Morgan and Company attempted to stabilize the market by buying large quantities of stocks, but their efforts were ultimately unsuccessful. Franklin D. Roosevelt's election in 1932 marked a turning point, as his New Deal programs sought to provide immediate relief and long-term economic reforms. The Glass-Steagall Act was introduced to separate commercial and investment banking, aiming to prevent such a disaster from happening again. Fast forward to October 19, 1987. It was a day that would go down in history as one of the most tumultuous in the financial world. The markets are on edge. Traders and investors alike are feeling a sense of unease, as if something big is about to happen. After years of strong economic growth, concerns about inflation and overvaluation are starting to surface. The market had been riding high, but the underlying issues were beginning to show. Rising interest rates and a growing trade deficit were also contributing to the market's instability. These factors created a perfect storm of economic uncertainty. Then, seemingly out of nowhere, the Dow Jones Industrial Average plummets a record 22.6% in a single day. It was a drop that no one saw coming, and it sent shockwaves through the financial community. This event, now etched in financial history as Black Monday, sent shockwaves through the global financial system. The impact was felt not just in the United States, but around the world. One of the contributing factors was the rise of program trading, where computers automatically executed trades based on preset conditions. This automated trading exacerbated the market's decline, creating a vicious cycle of selling. The Federal Reserve acted swiftly and decisively, pumping liquidity into the market and reassuring investors. Their quick action was crucial in stabilizing the situation. This rapid response is credited with containing the damage and preventing a broader economic crisis. The Fed's intervention helped to restore some confidence in the market. Amazingly, the market rebounded relatively quickly. Despite the severity of the crash, the resilience of the market was on full display. Within 2 years, the Dow Jones had recovered its losses. The recovery was a testament to the strength and adaptability of the financial system, and it provided valuable lessons for the future. In the immediate aftermath, investors and financial experts analyzed the conditions that led to the crash, seeking to understand and learn from the events of that fateful day. Dot-com bubble burst, when tech dreams turned into nightmares. The late 1990s saw a surge in technology stocks. Companies with .com in their names attracted billions. This period, known as the dot-com bubble, was fueled by speculative frenzy. Investors poured money into unproven companies, valuations soared to astronomical levels. The Nasdaq reached an all-time high in March 2000. The Nasdaq crashed, losing nearly 80% of its value. Countless dot-com companies went bankrupt. The tech industry faced massive layoffs. Venture capital funding dried up almost overnight. Telecommunications companies heavily invested in internet infrastructure suffered significant losses. The crash led to a more cautious approach to tech investments. Stricter regulations were introduced to prevent future speculative bubbles. However, some tech giants emerged stronger, laying the foundation for future innovation. 2008 financial crisis, the housing bubble bursts. This was a pivotal moment in modern economic history, marking the end of an era of rapid growth and the beginning of a prolonged period of financial instability. In the early 2000s, the U.S. housing market experienced an unprecedented boom. Homeownership was seen as a cornerstone of the American dream, and the market seemed to be an unstoppable force. Low interest rates and lax lending standards made it easier than ever for people to obtain mortgages, even those with poor credit histories. Banks and financial institutions were eager to lend, believing that housing prices would continue to rise indefinitely. This led to a surge in demand for homes, driving up prices at an unsustainable pace. People were buying homes not just to live in, but as investments, expecting to sell them at a profit in the near future. Wall Street created complex financial instruments known as mortgage-backed securities, bundling thousands of mortgages into a single investment. These securities were sold to investors around the world, spreading the risk far and wide. Financial institutions played a crucial role by aggressively pushing risky financial products. They believed that the diversification of mortgage-backed securities would mitigate the risk, but this assumption proved disastrously wrong. When interest rates began to rise and the housing bubble burst, defaults on subprime mortgages surged. Homeowners who had taken on more debt than they could handle found themselves unable to make their mortgage payments. The value of mortgage-backed securities plummeted, triggering a domino effect that crippled financial institutions worldwide. Banks that had heavily invested in these securities faced massive losses. Lehman Brothers, one of the largest investment banks, declared bankruptcy, sending shockwaves through the global financial system. The collapse of Lehman Brothers was a stark reminder of the fragility of the financial system. The crisis quickly spread beyond the U.S., causing turmoil in global financial markets. International banks that had invested in U.S. mortgage-backed securities also faced significant losses, leading to a worldwide financial crisis. Governments around the world intervened with massive bailouts and stimulus packages to prevent a complete meltdown. Central banks slashed interest rates and injected liquidity into the financial system to stabilize the markets. The recovery was slow and painful, leaving millions unemployed and struggling to rebuild their lives. The crisis had long-lasting effects, reshaping the global economy and leading to new regulations aimed at preventing a similar catastrophe in the future. COVID-19 crash, a pandemic plunge, and a remarkable rebound. In early 2020, the world faced an unprecedented challenge, the COVID-19 pandemic. Governments implemented lockdowns, bringing economic activity to a halt. The stock market plunged into a bear market faster than ever before. The Dow Jones, S&P 500, and Nasdaq experienced their fastest ever declines. Central banks slashed interest rates and injected trillions into the financial system. Governments provided massive fiscal stimulus packages to cushion the economic blow. Factors such as rapid vaccine development, easing lockdowns, and continued fiscal and monetary support contributed to a remarkable market rebound. Until next time, thanks for watching. If you found this video informative, make sure to like, subscribe, and hit the notification bell for more content like this. Understanding market history is crucial for any investor. And remember, these crashes, while significant, don't define the market's overall trajectory. The stock market is a powerful engine for wealth creation over the long term. See you in the next video.